welcome, and another beautiful day in Boston. I love Boston. Over the past several years, we've had a lot of investment in these marketing, ad tech companies. It's been expanding wildly. There is a lot of concern that we have, the market's very overhyped and very overcrowded. But then you have these big transactions, Buddy Media and Neolane. So now we have more tech startups that are coming out and looking for their exits and potentially exits in the public markets. And so we have to figure out what is the true value of these companies. And will they reinvigorate the public markets, the IPO market, or is this just going to continue to be overhyped? So we have our VCs, we have our Wall Street analysts, we have our operators here. They're all going to walk us through what their opinions are and predictions are for for advertising and marketing tech's future. So let me introduce the panel. So it turns out we do know each other, Brian. I thought that he was the one person I didn't know, but we've all been kicking around so long that we're all old friends, it turns out. So yeah, we're back to, Forrester days. Anyway, so I'm very interested to hear your thoughts. And so give your background, if you could.
Great. I'm actually going to use this because I have to keep my voice for tonight for something. I'm a career CMO, so I was a consultant for many years. I was CMO of a big company called Reed Elsevier, about a $5 billion publishing company that you know well. And then I was head of marketing and strategy at Forrester Research, publicly traded company based here in Boston. And then I was very fortunate to get in on marketing automation very early. I was the chief marketing officer at Eloqua, and got there when they were about $10 million. We took it to about $80 million of revenue in 4 years. Went public in August, which was wonderful. And then Oracle bought us for about $1 billion about 4 months later. So very familiar with marketing and outcomes. Very pleased about that. Super. And now I'm at Lattice Engines, which is a big data predictive analytics company.
Yeah. And Mark Grabowski, he's a legend in my mind. He led a lot of the revenue growth in the heyday, what I'm going to call the heyday of Yahoo. And so, I was just talking to him earlier, and he says, don't count Yahoo out. So anyway, but you go ahead and tell us what you're up to.
So my name is Mark Grabowski. I'm the Chief Operating Officer of Nanigans. Nanigans is a Boston-based SPMD on Facebook. In essence, we're a software company that allows advertisers to buy their Facebook media efficiently and drive towards lifetime value. We have about 140 employees. We run about $250 million of annualized spending. We're Boston-based. We have offices in San Fran, New York, London, and we're opening in Singapore and Australia in the short term. Prior to this, I was, in fact, at Yahoo. I was overseeing a couple of organizations, North American sales for display, as well as the Interclick acquisition and Right Media acquisitions. I've been in Nanigans now for a little bit over a year.
No, it was all good stuff. And again, he was a legend to all of us who were doing display advertising back in the early aughts, no doubt. So, and then of course there's my dear old friend John Guido. I've known him forever. He's been so helpful to me in my companies. He's been my go-to guy up here in Boston. But you go tell him about your.
Yeah, John Guido, one of the founders of AGC Partners. We're a full-service investment bank based in Boston. We've got offices out in San Francisco, Boston, New York, over in London, and we've been doing it 10 years now, and working with both bootstrapping venture-backed companies help access the growth capital markets as well as the mergers and acquisitions markets.
Yep. Wonderful. And then Jeff Buskang, who I've known by reputation from the days of You Promise, which was one of the most interesting pivots and business models that turned into such an incredible success. But you've done a lot of other stuff too. So.
Yeah, thanks. Can you hear me in the back? It's okay. I'm coaching my 11-year-old's football team this fall, and so screaming at people is becoming very familiar to me. So I'm Jeff. I'm a general partner at Flybridge Capital, where I helped start about a little over 10 years ago. And we do early stage investing, offices in Boston and New York. And we've done a fair amount in ad tech and marketing. Among our investments are Tremor Video, which went public earlier this year, Data Zoo, which is a Boston-based company, and 33 Across, which is a New York company in the ad tech space, Trax, which is a social media SaaS company.
So just to set the stage, and we've all talked about this, I'm just going to bolt through a few slides, the LumaScape slides, for example. So let's see. So this is our... Yeah, the AGC. So this is the display, very crowded, very crowded. So we have display, and then we have ad tech. And again, just, it's mind-blowing. These are very useful if you want to, quickly try and place people in their, relevant position in the ecosystem. So I'm glad somebody did this, because I do use these. I have them posted on my wall, so I sound like I know what I'm talking about when someone talks about, this vendor came in. I go, oh, yes. And then we have the Facebook stock chart. And of course, that's been a question: was it a failed IPO? What were the missteps? It's a transformational IPO in many ways. I have just a chart of Brightcove, which is a little older, and it's a more mature company in the markets. And the questions around Brightcove and video technology, for example, where is that headed? Rocket Fuel, very exciting, has done well. And I think it was personally, we'll talk about this, but I think it was a simple story. I think we're running into a situation where there are just too many acronyms, there are too many, DSP exchanges. It's like mind-blowing for even the institutional investors on the buy side to really understand what's differentiating and what's sustainable IP when it comes to these ad tech companies. And then I had to, and Millennial, just may have overpromised or underestimated or overestimated the promise of mobile monetization, which has been such a falling knife and with no end in sight as far as anyone can see. High concept, but where's the money? And then I have to include Retail Me Not, because this was a company founded by my old COO, Cotter Cunningham, and backed by my old financial sponsors, Austin Ventures. And so they went out this summer, and I just think they're a great model in the deal space. So I love the company, so I included the chart. So, but I'll leave this chart up, and what this is these are public valuations, public comps. These are some hot stocks. So you have Twitter, you have Tesla, you have LinkedIn, Facebook, and then you compare them with the icons of blue chip, which are American Express and GM. And I mean, it's really just astonishing. It's just incredible. So much valuation is taking place in digital media. I tell my kids, if you want a career, go into digital media or payments. Those are the two. Anyway, I'd like to just go down the line and say, how do you think about consolidation and ad tech and marketing tech, and given these complicated ecosystems? And we'll just mix it up, and I'll start at the end, Jeff.
Well, first, I tell my kids to go work for a village in Nicaragua. So I know about ad tech and payments. So this is telling. This is a very strange time as an investor, because honestly, as a venture capitalist investor, I'm pretty bearish on ad tech and marketing technologies today. And 5 or 6 years ago, when I invested more heavily in the category, I was very bullish. And the reason is that I think the category is maturing, and it's maybe in the 5th inning, maybe in the 6th inning of a maturation cycle. There have been some disruptive platforms, mobile one of them, social is one of them, which Mark is taking advantage of. But the time to invest in those platforms as a venture investor would have been 2 or 3 years ago. So as an entrepreneur, I think you've got to be very careful about approaching this market, because the giants have cast such large shadows. It's very hard to find white space today. As an investor in an existing portfolio with the public markets doing what they're doing, I'm very excited. That's why it's a little bit of a strange dynamic. I mean, Rocket Fuel got the attention. Thanks, Devin. Rocket Fuel got the attention of a lot of people on this panel because at a $2 billion market cap, that makes a lot of companies in this area and in New York City look very valuable. And so whether that sustains, whether it goes the way of Millennial, we'll see, and we could debate that on this panel. But there's a lot of frothy energy around this sector, which, as I said, feels like it's maturing, which means it's the right time for the public markets to be jumping in.
Yeah, and John, we had a chance to catch up on this yesterday. I really liked what you were saying as a preface.
So I'll try to make this simple. I try to, I work with companies trying to figure out exits and trying to figure out where they are in the curves of maturation and consolidation. A space that's very different but very similar is the HR automation space of 10 years ago.
Right.
There were, I don't know, similar 400-ish companies invested, same amount of capital invested. Invested capital and post-money value gaps between that and the fundamentals of, meaning the revenues, the gross profits, and gross profit trends and profitability. There were a lot of companies that sounded like they were similar, a lot of buzzwords. You went on everybody's website, sounded the same. A lot of guys were an inch deep and 20 miles wide. They solved everything, and some were so focused that they were actually a commodity. And what's happened in that space, I think, is what's going to happen in this space. A handful of those companies went public. You had Connexa and SuccessFactors and Taleo, a handful of others. You had a lot of little guys that were either not platforms or not solving a specific problem with defensible IP that went, eventually hit the rocks because they run out of funding. And then eventually the Oracles and the IBMs and the big tech platforms picked up and pushed that right into their full service platform. So I think when you look in ad tech, the story really comes down, and again, when you're an entrepreneur, you're thinking about the big problem, the big vision, and I think everybody's gotten that for a long time. But the problem is the disconnect for where these brands and where the companies are actually spending dollars, and how do you get that defensible revenue stream with escalating gross profits so you have a strong, healthy public company. And I think that's the disconnect on what's going on. So you have a lot of players out there. I kind of view it as a game of musical chairs. At some point, the Oracles and the IBMs are going to be buying players, whether they buy them after they've gone public and they're large public companies, or if they do a handful of smaller acquisitions. That's a little unclear at this point. But there's IBM sitting there, and they have core metrics on the analytics side on display. And the question is, when are they going to do that for ad tech? And I think the migration from direct response dollars to actual brand campaigns and visibility and putting some clarity into that black box is what the acquirers are thinking through.
And I'd like everybody to think about who are going to be the consolidators, because you mentioned IBM and Oracle. You could talk about Salesforce, Apple, Google, but we'll go back through and go ahead.
Can I make a comment?
Yeah.
John said something in talking about consolidators. It's really important for everybody here to recognize that a lot of these ad tech companies are based on a gross revenue model with margins in the 30%, 35%, 40% range. And if the buyer is a software company with gross margins in the 80 or 90% range, you've got an impedance mismatch problem, as you would say in electrical engineering. It just won't work. The buyers will not acquire low gross margin businesses. And so there's a little bit of a tension point for the non-SaaS players in the market space that has still not been figured out.
Yeah.
I want to add something to this. There's one other piece to consider. The ad tech cycle of consolidation is a 5 to 7 year cycle. So we saw this in 2007 when Right Media was acquired by Yahoo. There were hundreds of different ad networks that existed. There were thousands of point players. There was a consolidation that took place 2008, 2009, partially driven by the financial crisis. We're starting to see that same consolidation now, but something happens. And the reason that there have been so many upstarts over the last 2 or 3 years is because after companies get acquired, a lot of startups go away, and rightfully so. They're not executing, they're not performing, they're not offering any value. Then the large companies who acquire them, an example could be Microsoft, Yahoo to some extent, and even Adobe, they can't execute the same vision and the same expertise that those startups had as when they were independent. So again, you get a full new list of startups who are going to build up, try to either IPO or go for acquisition, and then you see the cycle happen over again. AppNexus is going through that right now from literally the same founders of Right Media.
Yeah, I mean, and thus it ever was, and all kinds of B2B. The best way to destroy a company is to have somebody big buy them, and then the opportunity comes back through the cycle. I agree completely. Anything else you want to add about the? So you think consolidation is now ripe for? So you're bearish on consolidation right now. I'm not sure if you're bearish. You're bullish on consolidation coming back?
No, to be clear, I'm bearish on new company creation.
New company creation.
In the space today.
Okay.
I think there's going to be a lot of consolidation because I think the market is maturing.
Yeah.
Yep, I agree with that, but to add to that, I think that you're going to, after the consolidation, a year or 2 years later, when the execution after consolidation takes place, you're going to have an entirely new group of upstarts trying to solve the problems that weren't fixed by the larger acquirers.
We need the innovation because it's going to be crushed.
Big companies kill innovation.
Yeah, that's right. So, and then
So
coming from
I'm a
marketers-
career marketer, so I'm a CMO, and it's a great time to be a marketer because there's just amazing technologies out there. And I'm sure you've noticed that there are a few big clouds forming. So Adobe has a marketing cloud, and core to that
When you
was...
say clouds forming, that's usually a bad thing, but in this case, this is a really, really good
It
thing.
can be a good thing. Depends on what position you're in. I think if you're a marketer, you may not want to buy from a big cloud. You may want to get best of breed rather than sort of a one-stop shop. I think that if you have a company, those guys have tens of billions of dollars, not onesies and twosies. So the Adobes and Oracle certainly, and SAP and others, and certainly IBM. So for me, it all started with Omniture. So the great Josh James started Omniture, went public. It was bought by Adobe. Adobe has since bought into marketing automation. If you look at Oracle, they obviously have seen wisdom in the cloud. They get into marketing. They've already been socking money out of IT. They wanted to take money out of the marketing team. They bought Eloqua. Today they made an announcement. They bought another acquisition. Anybody know what Oracle bought today?
Yeah.
Compendium.
Compendium.
It's a whole new category.
Yeah.
It's called content marketing.
Right.
And it's a brilliant thing, and it's a whole new category. And of course, Salesforce got into Buddy Media a while ago, and Radiant 6 social media monitoring, and they bought ExactTarget for $2.5 billion. They've got their marketing cloud. IBM, as you mentioned, Core Metrics. They also bought Unica, based here in Boston. They have other assets as well. So there is consolidation, but I would throw out the question to marketers: would you buy from Oracle, sort of one-stop shop, or do you want to get best of breed? I think the analogy is really ad agencies. If you think about the big ones, the WPPs and the Interpublics and Omnicoms, they for a long time been saying one-stop shop. You can get great PR, and you can get your digital marketing, and we can buy your display advertising, all get it in one place. But that vision has not reached the marketers, who continue to, I have 120 vendors that I work with. And I could work with fewer, but they're not the best. And so I pay a cost for getting the best of breed. So I really wonder whether the marketing cloud's going to take off. I know that IT people prefer to deal with fewer vendors, and they like more integration. But as a marketer, I prefer to get the best of each different category.
And then you drive your IT department crazy because they have so many.
I don't think you need the IT department anymore,
Okay.
which is great
Okay.
for marketers. It's all in the cloud,
Yeah.
and I can get stuff approved because we have a lot of discretionary money in marketing, and it's not on premise, so I bypass the IT guys completely. And in fact, I'm not sure if Scott Brinker's here, marketing technologist, but I have 2 technologists on my marketing team, so I'm completely independent. So I really don't rely much on the IT team anymore. I'm pretty self-sufficient with technology.
Well, Brian, when we talked on the phone before to prepare for this, I said I should just toss the ball over to this guy because he has all the cops in his head, and I will say we just went to the cloud, to the Amazon cloud, and one of the collateral benefits is it broke my heart because I love Akamai so much. They've been a great company to work with over the past 14 years for me and my different companies. But we don't need them anymore because the Amazon cloud is really perfectly fine as a CDN. So I just wonder, maybe some of these things that you want best of breed, how quickly can they become commoditized or copied or whatever? But anyway, so who are the natural consolidators going to be? Is there this mismatch in gross margin that's going to impede the SaaS providers? Do you agree, guys, or who are the natural?
I think there's 2 different waves. I think, as you've seen, Google and Yahoo have bought a lot of the big players that have direct response and have the big gross revenue, net revenue spread. I think a lot of those markets are going to continue to go to the Yahoos and the Googles of the world. Mm-hmm. I think there's like a new breed of recent, like some of Jeff's companies, like Trax, for example, that's a SaaS-based model. While they're early, I think they've got some real defensible IP that has that gross margin charge baked in there. But the question is, one of those players going to be at the scale that they then fit into the bigger picture? And I think that's when you'll see additional acquisitions where maybe ad tech and marketing are kind of merging together from a SaaS component from the large tech plays. The question is, I don't know when that's going to happen. I think that's that's another 5-7 years off probably.
Mm-hmm.
I think it's fun to see Twitter and Facebook emerge now as consolidators in the space. It's also great that AOL has gotten aggressive. They recently acquired AdaptTV. So instead of only having Google as the person that you can sell to, the company you can sell to, you are seeing a little more diversity, which is great. Yahoo has done, I think the number is 27 acquisitions. Now, the majority of those have been acqui-hires, which means $1 million per engineer and we throw away your product. So it's a little bit of a different strategy than what they did with Tumblr, which was, we love your product, you're going to report directly to the CEO, and we're going to nurture you and try to figure out a way to integrate our platform with yours. So I think a lot of this question about who the new consolidators are, the good news is that a few of these large consumer platforms are tilting more towards building advertising infrastructures, because that's where the revenue comes from, and they need technology to build out that infrastructure.
So we have to go to Mark.
I think that some of the consolidators are not only going to be, I do agree that Twitter and Facebook alike are going to become consolidators. I think Oracle, we mentioned, is another great example. But I think we're going to see consolidation in some of the smaller companies as well. I threw out AppNexus earlier, and I think there are going to be companies even below that level that are going to do some of these acqui-hires and some smaller point-play acquisitions. How many people in this room are in companies of 20 people or under? I mean, that's a pretty fair amount just for this room alone, where your valuations probably are not through the roof, where you're not a target potentially for a mid-sized company that has revenue of $50 million a year. So I think that you're going to start to see a lot more consolidation of the smaller upstart companies by some of those mid-range companies that haven't had the chance to really to jump or cross the chasm or kind of jump a track in terms of revenue. But they need a point solution for RTB or for data management or for something else that they just haven't really been able to build in-house.
And do you think that these smaller companies can be a single point solution if they aggregate around a medium-sized company? Or
Yeah, I think there are a lot of examples of sort of point solutions do very, very well.
Yeah.
I think you get to a certain threshold, maybe 20 million, and you sort of become inevitable. So inevitably someone's going to buy you, or inevitably you can reach 50 or $60 million and go public eventually. So I do think, I disagree slightly, Jeff. I think it is a great time to start a marketing software company. There's just so many opportunities in different places, and people are able to find opportunities. There's a little company called Influitive that does advocacy marketing. What the hell's advocacy marketing? It's about taking your customers and enabling them to advocate in your behalf. There's a little company in Boston called Gagalamp, and it's a way for Twitter, and you can get all of your employees. So these are point solutions, but very creative. They fill a gap in the marketplace that didn't exist, and they may grow up to be big trees at some point. Right now they're little seedlings. But I think it's a very exciting time, and they may consolidate.
Back in the day, we used to call those features and not businesses. You know what I mean? You remember? So I don't know.
That's the concern.
That's the concern.
It's interesting, though. None of us mentioned a huge player in this market that hasn't even come up yet, which is the ad agency. How many of you here work for an ad agency?
Yeah.
Just a handful? Okay, so this is an unbiased question. How many of you today would buy an ad agency public stock? Right. So one of the really interesting questions is, why haven't the ad agencies been themselves innovators and consolidators, and why aren't people more bullish on their role in the ecosystem? We could spend a lot of time on that topic. I think it's a very interesting and provocative one.
Well, I can't help but ask Sarah, do you have an opinion, Sarah? And I was going to bring up WPP. Is that the number one candidate for being forward?
They have made investments in technology.
Yeah.
WPP was an early investor in Buddy Media, which
Yeah.
probably made them more money than they've made in the last couple of years, from their agency operations.
I think it's a good time to start an ad agency, honestly. I think of Mobiquity, who's showing up in the hallway, who's starting a mobile ad agency. I think the big agencies are, they're constricted by low margins. It's a low margin business.
Thank you, Jenny.
Sorry, the big agencies, are constricted by being a low margin business and siloed businesses at a time when marketing activities are coming together. So, paid media has to be in sync with a lot of creative strategies, and it's very hard for a big agency to execute on that. But a smaller agency can do that, and we're seeing some really interesting smaller agencies, and particularly the mobile space. Oh my God, the big agencies have been so slow to get to the mobile space, and if you look at consumer behavior, 30% of web traffic is through a mobile device. I mean, why isn't this like a major part of a big agency strategy?
Mobile is tectonic.
But smaller agencies are emerging, and I think that there's going to be some, great value built in those categories. So.
But if you look at, obviously, multiples, so the agencies are going for 1x revenue. the companies we're talking about are going from 8 to 20 times revenue. It's kind of crazy days. And so I don't know why anyone would stay at an agency. I don't know how you liquefy an investment in agency. It's kind of a business that
You got to believe. You got to believe for the long term.
even if you believe you're successful, you're just not going to have that great an outcome with an agency, compared to software, of course.
I love this idea that we are, everything's going to be consolidated, and then everything's going to fall apart because they're inside bigger companies, and then we're going to need new innovation. I had a really interesting conversation with John yesterday about the health of venture capital and the health. So from where I sit, the very cool thing about this is you don't need money now to start your own company, to start a technology company. You can do it pretty much in your attic or basement or garage, or you really don't beyond friends and family. So you have the VCs coming in at not so much the seed level. Maybe you can find the right candidates, but also this idea that we went through this sort of explosion where you had almost too much money sloshing around, and now it's contracted. And I don't know if I'm representing what you said yesterday, John, but I'd love to put it out there again, because I think we're getting smarter money is basically.
There's two diffs. There's always this ebb and flow of when you raise money from the LPs to have funds, and then when there's liquidity in the open markets, whether it's the IPO market or whether it's the M&A market. I know a lot of everybody likes to talk about how active the M&A market is, but many don't realize it. In 2013, there will be less M&A deals over 20 million than there were in 2009, the year after the financial markets crashed out. Why that is because there's been so much consolidation, and M&A costs a lot of money and takes a lot of time, and is usually not as successful as everybody, whether it's on the M&A committee or the two CEOs that have this vision of the future. And then say, okay, we're going to slow stuff down and digest. And when that digestion starts, then all of a sudden, then there's this built up of private companies that are out there, that are funded, that are executing, that are focused on fundamentals. I mean, if you back up, right? I mean, when the internet bubble happened, there was a lot of companies with a lot of valuations that were paper valuations, and their products were on PowerPoint slides. 2008, valuations went down, but there were real companies with revenues and profits. And now, and while the tech market wasn't the culprit for the 2008, 2009 downturn, the quality of the tech companies was high, but everybody suffered because the liquidity dropped down so much. So then you have the venture folks, when I first got to know, a bunch of these private equity and later stage venture firms, they had $500 million funds, and they had 4 or 5 core partners, and everybody sat on 4 or 5 boards, and all of a sudden it went to billion-dollar funds and 14 partners, everybody on 14 boards, and then after 2008, it's been contracting. So with liquidity, it contracts, and then all of a sudden you're focused on fundamentals, you're focused on innovation, you're focused on performance. Then all of a sudden the buyers come back, the IPO markets come back, and so there's an ebbs and flows. So what Jeff and I just said when we sat down is, the last couple of weeks, it's the first uptick in M&A in about 3.5 years. And on the IPO market, it's probably the healthiest it's been in years, where there's actually, some IPOs like, Rocket Fuel and some of these others that we've talked about. There's a good line of quality companies and filings to go public. And now we're in this next realm, beginning of this next wave, hopefully. We're always trying to be optimistic on, I think other than Samsung and Apple, very few companies do invent the new. And I think the IPO markets, you need healthy IPO markets, so there's more buyers. And if there's more buyers, it keeps the big consolidators honest. Right now, in the last couple of years, the IPO markets have been sluggish, and the biggest buyers aren't afraid to say, well, there's very little other means of liquidity, so it's our way or the highway. So it's just ebbs and flows like that.
I think you mentioned someone there, Rocket Fuel, and I know that was on one of your boards earlier. They had a very successful, what looks like successful IPO, at least in the early stage.
Why is that?
Well, they have very large margins. I mean, they're taking incredibly large margins.
I also think it's just a simpler. It's a simple marketing story.
You're absolutely right. It's a simple marketing story, and my question is, how much value are they truly offering? How much long-term value are they offering?
Long-term value.
In terms of was a successful IPO, capital raised the amount of time it took them to get there, and their current valuation today. But yeah, that's the real question: is it really a sustainable public?
Right, and is it a good long-term investment? I mean, you would know that better than I would. But from a technology standpoint, they're not doing anything innovative. They're just not. They're doing a lot of retargeting, taking good margins on that, and ultimately for the advertiser, it's not very good for the advertiser. They're taking.
That's what I think, but
yeah, they're effectively buying it as low cost as possible, taking incredibly large margins. It's great for an investor early on, but those margins are coming at the expense of an advertiser. So that's why Jeff was talking about SaaS models, or software as a service, where you can actually see what you're buying, see the value that that provider is generating for you. The margins may not be the same as it is for an arbitrage model, but at the same time, it's going to generate more value for that advertiser.
And so, Brian, I mean, I know you're a brilliant marketer. I just wonder if you understand how crazy busy these people are. I mean, they're insanely crazy busy, am I right? And so isn't it very appealing to have something that's kind of simple? Yes, they're picking your pocket a little bit, but if it is a single points cloud solution, I mean, that's what
It can be. You know, great marketers have to evaluate things, you know, very carefully, and it's not just simplicity. It's got to really work for you. I would like to comment about your interesting point about capital raised, how much businesses need. I'm seeing sort of a bifurcation. You know, there are these companies that are sort of go big or go home.
Right.
And I think that the poster children might be HubSpot, raised over $100 million. Marketo went public, raised over $100 million. Domo, Josh James' new company, $130 million or something. So there's sort of those go big, go home, and those all need valuations over $1 billion. Then I think there are lots of, you know, interesting smaller companies that are really smart, and they're using other cloud-based services. A lot has become commoditized. You talk about Amazon services, and there are a lot of ways to do that. So I'm seeing a little bifurcation here. Companies trying to go further, maybe just with angel money, sort of holding off in the first round, and other companies that just want to go, you know, very big, like our own HubSpot here in Boston and Domo, which come to mind right away.
Yeah, and I have no idea how that happens. You know, we see invested capital, you know, at very high levels, and some of the B2B spaces, you know, because they actually have to do some work. I mean,
Well, the money's mostly in sales and marketing. So they
yeah.
built their product, and they just want to, you know, do a land grab very, very quickly. So I think companies that have raised a lot of money, they're putting most of it into sales and marketing now, just trying to get as much installed base as possible and get there before other guys do, and then try to renew it and get public first.
Yeah, I mean, I think the dynamic Brian's describing is a really healthy one, which is prior to achieving product market fit, you can launch a company for very small amounts of capital. AWS, the cloud, open source technologies, what have you, the classic lean startup methodology. But to build a big, valuable company, it requires a lot of capital. It requires a lot of capital to scale, to break through, to build a brand, to build a global distribution capability. So that's the reason for that bifurcation. As an entrepreneur, you want to be as efficient as possible until you hit product market fit, and then and only then do you want to step on the gas and raise a lot of capital to drive growth.
And I love the idea of global. I mean, is this something, as you step in, I mean, is that part of the playbook? Everything has to scale to global?
Well,
'Cause
you
I think
can get defocused very, very quickly. I've seen a lot of companies that plant a flag in Europe or Australia or somewhere way too quickly. So I think you ought to have a strong, you know, local presence. You can get pretty big with just in North America. So I've seen it sort of go that way. A lot of companies expand with partners overseas. So I've seen Europe and Asia Pacific work with partners. But I've seen that companies get defocused very, very quickly. They talk about translating their website. I'm not sure how many contracts you've done in France, but it slows things down a little bit. So, you know, and people so quickly take their eye off the U.S. ball, but it's a large, you know, market, and you really got to be strong here before you go elsewhere. So that's my point of view on globalization.
And Jeff, what do you do with your companies about global?
It's case by case. So some of our companies are quite friction-free. The key is how much friction is required. So we have a portfolio company, MongoDB, which is a database software company.
Yeah.
Open source database company, recently raised $150 million at a $1 billion plus valuation. Was very capital efficient in the early days, then scaled fast. Anyway, very friction free to download the software, open source. It's like in 120 countries before we had anybody on the ground in any of those countries, because it was a open source model. Crashlytics, another freemium portfolio company of ours that Twitter acquired, that was a similar model. Very easy to download, very easy to use globally. So those kinds of companies, you can go global very fast because they're friction-free. Other companies, it's a lot of friction. You need to put boots on the ground. You need to do translation. Those you want to be very slow and going global.
I will be a very happy woman when we leave Oracle and go to MongoDB, which is we're barreling towards that as fast as we can. It will have taken us 2 years.
Amen.
Yeah. So I'm sorry.
To add to the globalization comments, if a company knows what market they're servicing, for example, we service the e-commerce market, and we have about 200 advertisers, 250 advertisers who fall primarily within that market. If you find that other countries have a very strong presence for that market, for e-commerce, in our example, then it makes sense to globalize it can make sense to globalize because you don't have to do full translations, you don't have to change your software to accommodate different markets. Now, if you're globalizing just to go into other markets, and you find that different geos, and you find that other markets are bigger markets, then you have to start to shift your business, start to build tech around that. So, for example, if you find out that you need to go into China and the autos market is bigger there, that means we have to build new tech for that. That, to your point, right, is very defocusing. So that's, I think that's how we're looking at globalization, and or the smaller companies probably need to.
And does the buy side or potential buy side, how do they think about it? Do they think it's a distraction, or do you think you're not thinking big if you aren't global?
It depends on the success that you have, right? I mean, the first lesson is know your customer. Some markets, you got to figure out, how does that decision process get made? Who is that decision maker? The access to that decision maker that we have, where we've had our traction to date. I mean, if it's a tiny company that then gets distracted, there's a lot of those. So no, the buyers would not like that. But if there's a logical reason why to expand, and that you sort of dip your toe in the water and you're very smart about that and you have good momentum, then they get excited about that. So it's a double-edged sword. It depends on what makes sense in knowing your customer and then being smart in sequencing.
Great. And with the other conversation we had yesterday, John, is just about where's the leverage, where's the innovation happening, and so much of it is still left coast. And we would love to, see that grow here in Boston and New York. But frankly,
it's starting to. Yeah, we were talking about that yesterday. Jeff and I try to do as much as we can around the Boston area. I think back in the internet bubble, I think it got back to maybe 50-50 East Coast, West Coast. Before the internet bubble, it was, I think, historically more 70-80% West Coast. Right now, it definitely feels that it's more in that 75-80% West Coast. And then on the East Coast, New York. There was nothing in New York, I don't know, 5, 6, 7 years ago, and now there's a lot starting to get some decent scale. But when you go around the Innovation District in South Boston, you go over to Cambridge, there's a lot of little startups everywhere, a lot of good ideas, and hopefully folks keep executing on those.
Well, I do feel that New York is very much, just vomiting millions and millions of ad tech, everything's an ad tech company in New York. I say that with love and respect. I just don't know what's going to happen.
Well, what's going to happen is the left coast is going to get bigger and bigger. So all these companies are going to beget other companies. So the guys leaving Yahoo stay in Silicon Valley.
That's right.
And it's just going to get bigger and bigger. It's inevitable. So I think you've got to make a decision. I lived in Boston 25 years. I love being here. And in fact, people aren't interviewing during lunchtime like they are in Silicon Valley, and we can recruit from amazing schools here, and people love to live here. But you got to make a choice. I've got kids in college right now, and they're thinking East Coast, West Coast. But I think it's sort of an inevitable that West Coast is just going to, take over everything, just as Hewlett and Packard and all the people who were there started new companies, and just like the Facebook people are leaving and the Google people are leaving to find other companies, they're mostly starting them out there. So as much as I love New York and Boston, I think it's inevitable that the economies in Silicon Valley are just going to grow much, much faster than our local ones, as much as we love to live here.
Yeah, but I think that 10 years ago, your options were really limited in Boston if you wanted to be in tech.
Heavy iron.
What's that?
You were so heavy iron.
Yeah, that's exactly it. I mean, right now there's so many younger companies, growing companies that are now 100, 200, 300 people or larger. So you actually have some options. That really didn't exist. The other thing is that companies in Boston I've been finding have stronger fundamentals than what you'll find in companies throughout the rest of the country. And it could be because the venture community is so focused on making sure that the companies actually don't just have an idea and can actually execute. It could be just the kind of East Coast mentality. But I think that you're seeing the companies here in Boston are not going to be companies that are around for just a year or two and that spend too fast. I think there are stronger fundamentals and more profitable companies that you'll find in the East Coast.
Well, I don't know if that's true in New York. I mean, it really does feel like there are a bazillion, features or ideas or not even well thought out ideas. I love fundamental performance, so I'm really pleased to hear it happening in Boston. And but does that 80% hold true for your portfolio mix? Is that right? Or
well, at Flybridge we're a little different because we focus almost exclusively on the East Coast, and we have offices. We kind of re-engineered the firm to be split evenly between Boston and New York, so we spend a lot of time in both markets and have equal-sized teams in both markets. I disagree, by the way, that New York is feeling light and feature-ish. I think there's an incredible number of substantive companies in New York, not just in the ad tech and marketing space, which we're here to talk about, but also cloud companies, payments, security, New York's fintech. I mean, it's an extraordinary market right now. And, Brian made the comment, he thinks that success will beget success in Silicon Valley, and I think there's an argument for that, for sure. But if you look at the private companies, Business Insider recently did the 100 most valuable private companies. I think something like 7 or 8 of them, of the top 50, were in New York City.
Okay, yeah.
So there's a lot of very valuable and interesting companies in New York.
Did that include Bloomberg? Anyway.
It did, actually.
Yeah, so, yeah, that's heavy iron. But you can't hire open source developers in New York. It's very, very, very difficult. It is not the same culture as Austin, even Chicago or California. And then everything seems to be .NET out in Seattle.
So I'll give you a data point on that. So 10gen is headquartered in New York City, but also has an office in Palo Alto. We have interns from top schools for the engineering department, and then we make them an offer at the end of the summer to come back, and we tell them you can choose between Palo Alto and New York City. So where would you think people, if you're a 22-year-old hotshot engineer, where do you want to live lifestyle-wise? New York City. Every single one of them chose New York City this year.
Well, keep them coming.
Every single one of them.
Back up the truck. We need as many
Yeah.
of them as we can get. That's fantastic.